Hi everyone, Mike here. The purpose of this video is to share with you how we use Income Lab. How do we input things? And I'm going to show you how simple this is and how powerful it is. Now, a couple of disclaimers before I dive in. Number one, Income Lab does get updated periodically. So when you pull up Income Lab and you look at it and you're looking at different, maybe different parameters or boxes that when you watch my screen, you're like, hey, it doesn't look quite like that. Well, maybe they've updated their system. And if they updated a lot, I will probably re-record this. How about that? Um, the second thing that I want you to know is that when we are in our second meeting, we are not actually showing Income Lab to the client or the prospect rather. What we do is we show our prospect a PowerPoint slide presentation, and we will take screenshots of different portions of Income Lab and drop it into our PowerPoint presentation. We actually do not open up Income Lab itself in front of a client or a prospect until they become a client. Once they're a client, they have not only do they see the actual system, but they have access to it. But during the conversion period, prospect to client, we're only taking screenshots out. Now, you may do things differently, and that's fine. If you want to actually show them Income Lab, nothing wrong with that. And if you, there are, I will go through this and I will comment. Here are the sections of Income Lab that I think are the most valuable to show to people. So there we go. With that, let's go ahead and open it up, and I'm going to show you how easy this is. It's really cool. All right, share my screen. Now here I've got Income Lab pulled up. I am going to add a household up here in the right, and I always add standard. I always do standard. So let's go ahead and dive in. So first we're going to put in the sample family, John and Jane Sample. If Now, what is the email address for? We do not fill out their email address until they become a client. Why? Well, let me just drop in one of my, let me drop in one of my email addresses, Mike, and I want to retire well. So that's my email address. Now, let's say that my email address is in here. Well, I can now open up plan permissions, and there are three options. There is no income plan access, or they can view the income plans, or they can view, create, and edit income plans. So here's how we do this. Once they're a client, we will put their email in. And once they're a client, we will then click can view income plans. Never, ever, ever do we click the bottom one. It's the middle one. I would beg them to get rid of this bottom one. You do not want clients going in and messing up the income plans. But can view is a good one, right? Why is this invalid? I don't know why it's an invalid email address. Probably because the name doesn't match. What if I said John at, I want to see now, look at that. So it looks like you have some issues there. But anyway, you can um, you can give the person ability to go in and see the system just like you see it. Now, again, we don't even bother with that until they're a client. After they're a client, we let them view it. But when we're in prospect stage, no, they don't have access. So we leave that blank. Client info, we're going to include a spouse and a partner. And we're going to have in this case, the typical male, female. We've got John Sample and we've got Jane Sample, right? And let's go ahead and drop in a couple birthdays. Let's imagine that John just turned 63 and he's going to retire in a couple of years. Jane is a couple of years younger. Let's say June of 1963. There. She's a year and a half younger. And for the purposes of today, we'll have her retire. They're going to retire at the same time. Now, once you've got this very basic information in here, you're going to hit Save and Create Plan. And now you're going to go to the input tabs. Now, these input tabs at the top are Plan Info, Assets, Income. And then when you hit this little plus guy right here, you'll also find Liabilities, Savings, Expenses, and Insurance. And we're going to fill out all of this, and it's super easy. If you messed up, you're like, oh my gosh, I got a birthday wrong. You can just click this little Edit tab up here, and it brings you right back to where you started. but this is all accurate. So I'm just going to hit save again and we go back to this. Now, here's something to be aware of. What if you accidentally hit this finish button before you complete filling all this out? I'm going to show you what happens if you do that. Don't panic. All right, here's what we do. We have a plan name. We always start with current. We just say, hey, where are you now? John and Jane are in this plan. I am in the state of Texas, so make sure you pop that, whatever state you're in. And if you scroll down at the bottom, is the client retired or not? Well, we are going to say no. We're going to say John is going to retire. He wants to work through the end of 2026. So he will retire January 20. I'm sorry. Let's do it this way. He's going to retire 12 of 2026. When he is 6, that's when he's going to retire. That's his last working month. And Jane, to keep this simple, we're going to have her retire at the same time, 12 of 2026, when she's 63 and 6 months. Now, we're going to start the plan at John's retirement. This is when are you going to start to pull money from their portfolio, other than, when are wages no longer going to drive their plan, basically. So you can start the income plan at his retirement, her retirement. Typically, we're going to use the one. You can pick either one, but for now, we have them retiring the same day, so it's fine, right? Now, here's where if you mess up, this is where you're going to mess up. Sometimes we mess up and hit finish here, which I told you not to do. But let's say you did it. Well, if you hit finish, oh, it says, wait a minute, this whole scenario is incomplete. Edit plan scenario. Okay, great. Another way to edit it is just go up here to this little icon up here and click it, and it'll hit. So we can hit either this button or this button. I'll click this button up here and it takes us back to the same place. I'm like, oh, phew, that was a close call. All right, well, let's go ahead and start putting in some assets. Now, assets come in these different categories: investment assets, annuities, banking accounts, and other assets. Now, here is the problem with this structure. Other assets are going to be things like real estate, collectibles, that type of thing. Banking accounts, self-explanatory. These two assets on the right, banking and other assets, are not included in the income plan. Investment accounts and annuities are. Now, I'm going to click annuities because you need to know this. I almost never, at this stage, I almost never use this tab. And the reason is this tab only applies to lifetime income annuity riders. So if you have an annuity that is a growth annuity, or maybe you won't use it for lifetime income, then it would not be put here. It would be put in the investment account side. This is a tab that is, they are working on updating it to include both income annuities and non-income annuities, but for now it's only income annuities. And I'm going to show you that here so you know how it works. So let's pretend that we have a joint FIA. And it's a fixed indexed annuity. So that's the other thing. It can be variable or fixed index. That's it. The account type is let's say it is a traditional IRA. Ownership, it's in John's name, but it's a joint FIA because it pays out for both their lifetimes. So we could also say, let's just call it John FIA. Let's say it's an IRA in his name, and there's $200,000 in it, right? Now, we're going to hit this little gear icon next. And this is how you set this up. Over here, index annuity, traditional IRA. This is what we just already typed in over here. But the thing you need to know is asset allocation. You can don't mess. This is customized. That's for variable annuities. But this is an FIA index, large cap index. It's the only option you have. Don't worry about this right now. It's just not that important. Here's the button though you need to hit: annuity settings. So let's click on that. And this tells you all the information you need. Okay, here's my benefit base. It's 200,000. And here's my withdrawal rate. And by the way, the benefit base might be higher than the account value. Like let's say it's, I don't know, 225. Whoops, not 2 million there. And not here, 225. Let's say that's what it is. It's going to cover both their lifetimes. It's a lifetime withdrawal. You could do a time period like 10 years, 20 years here, but it's lifetime. If you want to click advanced settings, will you withdraw the RMD if it's greater? No, I will not. Make sure you click that. Lifetime income, you're not going to do that probably. How does the benefit increase? Well, anniversary month is January. Let's say it's December, or let's say it's November on his birthday. It's going to roll up at, I don't know, 6% per year. Benefit increase during withdrawal phase. That's going to be high watermark typically. And then when you scroll down, basic annuity projections use guaranteed growth and specific. That's fine. Display annual income growth during withdrawal phase. Yeah, we're going to assume no. End of, yeah, we don't care about that. Here, guaranteed growth of benefit is compounded, non-stackable amount on which roll-up is based. Right now, it's the 225, right? And crediting methods, it's a cap of, I don't know, 8% maybe. Who cares? I mean, because basically all we care about is the income that's coming from this. And then the fees, let's say there's a living benefit fee of 0.95, right? There, save. Now, this will now show income from, for their lifetime during retirement. Oh my goodness. Let's click that again. Annuity settings. When does begin withdrawals? I put the date wrong. The withdrawal should begin January of 2027 after they retire when John is 65. There. There. Now I've hit save. Now that's the only thing you'll ever put an annuity in. Let's go. I'll do investment accounts last. For banking accounts, oh, look, they've got savings, right? And it's both of them. And they've got 50,000 there, say. And they're getting, let's say they're getting 1% interest there, which is fine. Cool. Other assets, they've got primary residence and they both own it, and it's real estate, and it's worth, I don't know, 800,000, right? And I'm going to click this icon right here. This is really important. If you're going to sell it and all that kind of stuff, you can play with this here. Mostly here, I just want to put in a 3% growth rate, right? And hit save. By the way, I should have said this earlier. If you ever have questions on any of this stuff, call Income Lab. Like these guys are really super helpful. Let's say they have some rental income or rental property, right? And again, it's in their joint name. It's real estate, and let's assume that the value of their rental property is, I don't know, 350,000 there. And again, you hit the little gear icon. I want that growing at 3% there. Now, I know what you're asking. But Mike, what if they have a mortgage on these? Where do I put that? Mike, this is a rental income. That's going to be an income that I'm going to have to account for. Where do I put that? Don't worry, we'll get there. The income tab is up here. If I click the plus sign, liabilities, savings, expenses, all the tabs are up here. Don't worry about it. We'll get there. We're just putting in assets right now. We've got annuity, we've got banks, other assets. Now, investment accounts. Let's click on this. Okay, John is working. John has a 401k. And this is a traditional 401k. And John has, well, I don't know, 400,000 in it. And again, is John adding money? Yes. We're going to put that up here when we get to our savings tab, right? That's where we're going to add money to this thing. I'm going to click the gear icon right here. And really important, because how is that annuity invested? Well, if he's like most people and all, by the way, this drop down, you have some options. Don't mess with it unless you want to. Don't mess with it. This is for a prospect. Don't go overboard. For clients, you might want to go in and hit custom or build model allocations, but this is a prospect. Most people, their 401ks look a lot like this. So I just move the slider and I put it there. Why is that important? Because when you do that, look what happens right up here. It's going to calculate your entire portfolio down here. Average return, standard deviation. Now, Jane, she has a 401k, and it's also a traditional 401k. And Jane has also 400,000. And let's say that Jane, let's pretend she's a little more conservative than John. And so she's got a 60-40 mix. So that's fine. right? Now, notice if I update the average returns, this average return went down because they're invested differently, and the standard deviation went down. Oh, let's say, um, and let's say John, let's say both of them are now just starting to put money into a Roth 401k. So I'm going to call John Roth 401k. And this is going to be a Roth 401k. So there it is right there. John is my owner. He's just started doing this. He's got like, I don't know, 25,000 in it, right? 22,000, good enough. And we're going to click our gear icon because again, we need to make it, change our risk to, a little more aggressive. And Jane, just keep it simple. She also has a Roth 401k. And again, it's Roth 401 and Jane. And again, I'm just going to give them the exact same amount. And but remember, she's more you're more balanced investor. So there we go. So this is going to be important because even if they're going to start putting money in a Roth and they have no money in a Roth yet, you still have to put $1 here. It won't accept a zero. And finally, they have a joint investment account, joint investment account, and it's taxable. This is a joint account. And let's say they've got $280,000 in this, right? Now, super important, my friends, super important. Click this gear icon every time you hit a taxable account. When you click the gear icon, not only do you have to put in how they're invested, and let's say they're invested more aggressively here, notice what's happening up here. Cost basis is one. Oh, it defaults to half of this number. You want to make sure you get their cost basis in here. And let's say it's 234,000 just for today's discussion and hit save. Okay, these are their assets. So we've got their investment accounts, annuities, banking. We've got all their stuff in here. Now, let's click the income tab. Income tab. Okay, on this page, here's where the Social Security goes. We're going to click yes. And you can estimate it. Let's say you get a statement from them and you find out, oh, look, John's primary insurance amount is going to be, and this is at his full retirement age, is going to be, I don't know, $3,000, right? And Jane, just to keep it simple, is also 3,000. Let's say they're both going to be 3,000 a month primary, right? So cool. But then when we scroll down, okay, we can calculate our options, right? And you scroll down, it's like, oh, this is what they get at full retirement. But guess what? Remember, they're going to retire when? They're going to retire. They're going to start collecting um, 2027, January of 2027 when they retire. Let's say they're going to retire right when they're going to start collecting right at retirement, both of them. And notice how she's going to get a little bit less, right, than he is because of she's going to start at a little bit younger age. So she'll get penalized a little bit more. So let's say that you've got that for Social Security. Other income here. Okay, John, employment income. Remember, he's getting employment income. Let's say let's say they're both getting paid 150K a year, 12,500 a month. And that's going to be John. This is going to be, if I scroll down, wages. Oh, by the way, notice, see how Social Security's here again? You might need to use this if you come across someone that has a big pension and they're getting like a real small amount of Social Security, then things might get a little weird on your Social Security tab on the left because if under Social Security, if the spouse, let's say John has a big pension. I had this happen the other day. John has a big pension. His Social Security was like $300. It was not half of Jane's. It wasn't even close to half of Jane's, and the system overrode it and made it half of Jane's. So if you get some weird outcomes from Social Security, just know that you can just put the main Social Security in this section, and then for other income, drop it in here. Okay, so John's employment wages. Remember, hit the gear icon. Just get in the habit of hitting the gear icon. Let's see, his wages are adjusted for inflation. It's happening monthly, but it doesn't end at his death. My goodness. No, it stops when he retires. And then you're just going to hit, further, is a joint plan. Will it change if one spouse passes? No. Save. Okay, Jane employment. Let's get her in there. And again, 12.5. And this is Jane. And it's again, scroll down wages. And again, we're going to click the gear icon and we're going to go down and say, this is going to end at Jane's retirement. Save. There's employment income. Now, what if one of them has a pension or rental income? So I'm going to go pension / rental. Let's call it rental. We gave them a rental property. Let's call this rental income. And they're getting $1,000 a month net. They're joint owners. And we're going to hit here. This is going to be, it could be listed. I would list this as investment income. Rental income is usually ordinary income also, but for now, let's click at investment income. Click our little gear icon. Now, by the way, if this were a pension, it'd just be ordinary income if this were a pension, right? So since rental income is taxed as ordinary income, this is fine. We'll leave it there. Let's click our gear icon. We always want to do that. And let's review the details. It's $1,000 a month. Now, is this adjusted for inflation? It's a rental, so yeah, it's going to adjust for inflation over time. If this were a pension, though, we would click this and say not adjusted for inflation. But this is a rental, so we'll adjust it. And if you want to create a custom inflation, you can at a custom rate. I'll just leave it like that. Tax treatment or income. It comes $1,000 every month, and it's currently happening. As long as it's currently happening, you can just leave it like this. When does it end? Well, this income will end at second spouse's death because it's rental. It lasts as long as they plan on keeping it forever. But this is really important. Let's say it's a pension and it's a joint pension. Let's say it covers both of their lifetimes. Well, it still ends at the second spouse's death, but this becomes an important question. Will this income stream change if one spouse passes away? So let's say it's a pension for John. And when he dies, it gets cut in half. We would hit yes. And if you do that, you say, well, after John dies, how much would this income stream pay out? Well, if John dies, if this is a pension and Jane gets half, we would make it $500 to say, oh, look, if John died, half of that went away. But if Jane dies, well, John's still going to get the full amount if it's a pension in his name. But in this example, it's rental income. We'll leave that at a no and hit save. All right. Okay, so let's say that's it. They have Social Security, rental income, and their retirement portfolio. So, and let's say we accidentally, oh, wait, we forgot to put in all this other stuff. We're just going to accidentally hit finish. And it starts doing this thing, right? And you're like, oh, darn it. I screwed up. Oh, boo. I messed up. And so it loads all this information. You're like, oh, wait a minute. I'm not done. I didn't put a bunch of stuff in. I need to hit this little icon right here. But before you do, notice this right here, spending capacity. Already, whoops, I didn't mean to click it. Sorry. Already, this is telling you, and if you click this little gear icon up here, I always want it to say nominal. And I always add variable expenses. It didn't change the number yet, but you'll see why soon. But what this is already saying is based on the income that was put in, based on their life expectancy, based on their cash flows and their assets, they could spend about $14,000 a month gross. Gross. If you say, well, what is that number net? I just click this icon up here, hit net. That's about $10,000 a month net. So we are already getting some information here that might be helpful to know. But we're not done, and we need to put a bunch of information there yet. So let's click our little edit button right here and drop that in there. And back we go to where we are. So we've got assets in here. We've got income in here. It's all in there. Income, other income, yay. But we've got to hit our little plus sign, and we need to do some things. Liabilities. Well, wait a minute. Let's say their rental property is paid for, but their we'll call this mortgage primary residence. They have a mortgage on their house, and it's something that it's in both of their names. Excuse me. It is a mortgage, and let's say they owe $400,000 on their $800,000 house. And you can put in a dollar amount or a rate of return or a percentage. Let's use a dollar amount. And so, how much are you paying on your mortgage? Not if they escrow mortgage and property taxes, you want just their mortgage payment, just the mortgage payment. And let's say they just moved in. Let's do this. They said we just moved in. It's let's do it this way. It's a we're paying I don't know, 3,000 a month, right? So that would be, let me get my calculator here. Let's say 3,000 a month. Let's do this. That's 36,000 a year times the next 15 years is five. Yeah, let's just for the sake of discussion say they're paying 3,000 a month and this will be paid off in 15 years. So we'll say that this is paid off by 12 of 2039, right? We're going to hit our, now what are we going to do? What do we do all the time? Hit our gear icon. Super important. The balance is of today, blah, 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 blah. This tells us how we're doing everything. Now, include payments as an expense item in baseline expense or other variable expense. We just leave it as other variable expense. If they're going to pay it off early, you can drop it in here, but we just leave it right there. Now, this is important. Remember that this is here, okay? Let's say that's our only major liability. Well, what comes next? Savings. Okay, John, 401k contributions, and John is putting, so what's a target account? Well, it's his Roth. Remember, he's adding to his Roth. And so how much is he putting in? He's putting 10% of his salary. He's getting 12,500 a month, so he's putting in 12,500 a month. If you click on icons here, is it going to adjust for inflation? Yes. And when does it end? At his retirement, that looks good. We have Jane 401k contributions. And if you want to say Jane Roth 401k contributions, that's fine. The target account, Jane Roth. Again, 1250. And again, the gear icon, everything's going to be set up the way, stop at Jane's retirement. There, save. John, 401k company match. And so we go to John 401k, that matches the basic match. And let's say they're matching 3% of his income at the safe harbor plan. So if he's making $12.50 a month, 3% of that is what, 375 maybe? Yeah, 375. Bum, bum, bum. And again, gear icon, it ends at his retirement. Beautiful. We have a Jane company 401k company match. And that's Jane 401k, also 375. And again, make sure, I know they're retiring the same day, so this shouldn't matter. But for good practice, just make sure you've got it stopping at her retirement, because what if you change her retirement date, right? Let's say that's all they're saving right now. Now, here's a weird thing that my team tells me. They say that you might, for if they're still working, if this number is really big, you might want to put it under, like, let's say it's 1,000 a month. It's a big number. You might want to go into their income side and say, oh, here, wait, let me do this. This is all we need for savings. They say, hey, you should go on the income side. And what you should do under other income is you should add in John 401k company match. It's 375 a month, John, and this is not taxable. And this is going to end at his retirement. And then you're going to do Jane 401k company match. And the reason you do this is because if you don't, whoops, Sean company match, Jane company match, 0% taxable, and this will end at Jane's retirement. If you don't do that, if you were to try to calculate Roth conversions while they're working, it's assuming that these savings right here, it assumes that every dollar of the savings comes out of their income. And we know that this is not coming out of their income. This is a company match that would represent a tax-free income for them. So there, just a little quirk here that you want to add in. So there's our savings. Well, what else do we have? Here's expenses. So now here's a question. How much money do you want to spend in retirement? And I don't itemize it. We just baseline. We just say we add it up. But remember, we said 3,000 a month is going to their mortgage payment. Remember that? So if 3,000 a month is going to mortgage, we want to say ignore that. On top of the 3,000 a month, how much do you want to spend in retirement? And they say, well, we're used to spending, they're getting, almost 300 of income now. Let's say they want to spend 10,000 on top of that, right? That's just what they want to spend on top of their mortgage. And so we'll drop that in. Now, super important button here. This button right here, change this. Click it. The system will automatically try to calculate what they can afford to spend, but we don't want that. We want to ask this question: how can I spend 10,000? And I'm going to hit done. So you click that button and hit done. I'm going to come back to this button later. By the way, let's make this, I'm going to drop this down a little bit. Let's say it's 8,000 a month. Say, hey, if we could have our mortgage paid for, we can be comfortable on 8,000 a month. Let's do that for now. All right. So that's expenses. Now, other variable expenses, the mortgage isn't showing up here, but if you want to include things like major purchases, let's say they wanted a travel fund, you could put that in here. We want a travel fund for the next, X number of years. That could be added here, that type of thing. Last thing is insurance. We haven't done any insurance here. Let's assume they have, John has term insurance. He's got 500,000 and that's going to last until he is, I don't know, for the next 10 years, say. And same with Jane, right? Let's just give them each 500 of term insurance that lasts for the next 10 years. Whoops, I need another zero there. Great. If you click the icon, you can add a premium. We don't mess with that. Okay, now I'm going to hit finish. And now it's going to prepare the plan. But we're not done yet. There's one more little thing you need to do before you start diving through all of this information. One little thing. So we have to wait for, I call it our little blue spinny circle. And we're going to get this again in a minute because I'm going to make an adjustment somewhere. There are a couple of things that we do. Now that everything's loaded, there's a couple things we're going to do. We're going to click, see these three vertical dots here? I'm going to click those. And we are going to hit Advanced Plan Settings. I'm going to go to the Tax tab right here. And I want to make sure right now, I mean, there's things you can play with, but again, most of this stuff, again, this is for a prospect, so I'm not going to play with a lot of this until they're a client. But I want to make sure that these options are taxable, tax deferred, tax free. Like, let's say it looks like that for some reason. You just click on it and you drag it in the order you want. That's number one. Number two, go to the very bottom and click this button. Specify years when Roth conversions are allowed. And you get this, customize years. Click it, select all, and hit save. You're going to need that when you're doing Roth conversion calculations. Next, the other thing we play with, and you can look at these tabs like Medicare and all that kind of jazz, but right here is the one, if they want to leave money, like they want to leave a certain amount of money to somebody, you can put it there and all this other stuff. But, fees and expenses, just leave them blank. Here's what you care about. This one right here, longevity settings. We always like to kill the husband off at age 85. So the way you do that is you click the little calendar icon right here and you say, oh, look, he's 63. I'm going to change the date until he's 85. I need to add 22 years to this. So I need to make this 46. Now he's 85 years old. And I'm going to let her live above average. Save. Everything's saved. Oh, save that too. So every time you make a change like this, you got to hit save. Now go back. We're going to get our blue spinny wheel again. But now the plan is ready. And I know it took me a long time to go through this. I don't know how long I've been on this so far, but I can tell you that in practice, we zipped through this way faster because it took longer because I was explaining everything to you. All right, let's take a look at what's going on here. So the first thing I do is see this button right here. I click it. And again, what am I looking at? Nominal, monthly, gross, variable. This tells me $12,000 is what the target is. This is their target. Now, actually, if you want to hit the net button here, you could say, look, you are targeting 11,237. Now, how is that possible? You said it's 8,000 you want to spend per month, plus the mortgage is 3,000. How did we come up? That should be 11,000. Well, it's bigger because look at the date up here. That's based on December 2026. So that's inflation. Now, what are some things that we look at? The first thing, if you're talking to someone, go to here, go to Life Hub and click this. And the first thing we do, if I'm talking to a prospect, and you click this, I like this one right here. Click that. And oh, look, I got to make this bigger so we can see it. If you're used to asset map, this is really cool because look, it says, look, here's where your income's coming from, right? Here are your portfolio withdrawals. Here are your baseline expenses, things like taxes right now, things like savings up at the top, current accounts adding up. Here's your savings. Here's your other real estate. Here's your mortgage. If they have a vehicle loan or something that's down here, here's your life insurance. If you're used to asset map, this is kind of like asset map. But what's really cool up here is it's got a slider. So I can say, oh, well, look, what happens after they're both retired in 2020, let's say 2027, right? If I do this, I'm like, where does the income? Oh, now it's come from Social Security. Their employment is done. So they've got Social Security income. So that's about, call it 60, 72 of income. But what are they trying to get down here? They're trying to get at 136. So half of their income, where are they going to make it up from? Well, it's right here. Portfolio withdrawals. They got to pull $64,000 out. How much money do they have? Well, about 1.6 million at that point in time. And you can start doing the math if you want. You can say, well, gee, 64,000 divided by 1.6 million. Is that going to work times 100? Oh, look, that's about a 4% rate of return. Almost exactly. Wow. I got lucky on that. So it should work, right? And then you can see, okay, well, what happens here? Right? Well, what happens in 2034? Something else is going on. Oh, that must be, usually this is labeled as, oh, look at that. John 74, his RMDs must have started. Oh, no, RMDs started 75 for them. What isn't, something happened here. Oh, their health insurance, or I'm sorry, their life insurance went away. If I put my cursor there, look, it highlights what changed. If I put my cursor here, it highlights, if I scroll up a little bit, highlights what's changing, highlights, everything highlights. RMDs, right? You go to RMDs. If you look at that, that's when they start for John. House is paid off here. Look, the mortgage goes down to zero, and also their income needs go away, right? The mortgage, their resident payment, look what happens here in 2040. Now it's zero. So this is really kind of cool. Uh-oh, what happens? John dies. John died, right? And then out here, we've got Jane dying, right? So it's kind of cool. But normally we just start on the first page. Hey, does this all look right? And if you want to print this page, it's really cool. See this little guy right here? Click on it. Generate report. Ba-bum. And then you're just going to say, boom, boom, boom. Get rid of all this stuff. Get rid of the cover page. Just a one-page report. And portrait landscape. Download it. And it'll download. And you get our little spinny wheel. But this is something you could give to somebody. It looks really cool. Here's what it looks like. I'll make this a little bit bigger. And I'll shrink it so you can see the whole page, right? Bum, bum. There, you've got it all on the whole page. You can print this out for them. It looks really pretty. And, there's a disclosure page, right? Ta-da. There, get rid of it. All right. That's Life Hub. Always, always, always in this thing, I notice I leave everything nominal. Everything nominal is what I do. And you can save it and do all kinds of stuff. There, my default viewing options have been updated, right? Cool. Now, let's go back to this. Here's a couple other things that I like to show people. So notice here, I've got nominal, monthly, gross, always add variable expenses, right? If I want to show net, we can. There we are. So a couple things, cash flows. Let's click this one. So these are the pages that we will take screenshots of and show people. And I am now going to flip to this mode so we can see it really well. Here, and let's move my stupid picture down the bottom. Well, went up to the top, whatever, it's good enough. Here, notice how it prints out where the money's coming from, right? Dun, 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 dun. We have employment income is here, and you can kind of see company matches, and rental income is this dark blue line at the very bottom. They retire. And now what do we have? Now we've got rental income. The light blue color is John. You can see right up here. The yellow is Jane. This is their Social Security. The little gray, that's over here. That's the lifetime income annuity. And then we now have portfolio withdrawals is the green. And then look what happens here. Oh, look, that's where John dies. We see one of the Social Security checks going away, right? So there, that's kind of how that works and kind of give you some income ratios. Here is a page. I love, love, love this tab right here. Love it. Click it. Dun, dun, dun. This is beautiful. Hey, John and Jane, look, here's your income tax. You know, this is what we're paying Uncle Sam in the next few years. Then you retire and look, you pay almost no tax, although there's this little green. You know what that little green is? Yeah, that's Aunt Irma. Well, then, we got a little jump here. Why did this jump up in 2036? Oh, John turns 75. His required minimum distributions start. Here's another jump in 2038. Why? Now Jane's 75. Her required distributions start. And what's happened now is your required distributions are more. You've got to pull out more money than what you wanted to live on. And then it's growing, growing, growing. And here's another jump right here. And then, woo, things go crazy. What happened here? Well, guess what, John? You're 85. You died. Now, if you want to see this in a table format, down at the bottom, we can hit Show Table. And this is something I do every time in our PowerPoint. We take a screenshot of this stuff. And we say, look, here's your taxes right now because you're making like 300 grand. You're in like a 24-25% effective tax bracket because that's you make a bunch of money. But then you retire and look, your taxes go way down. Why are they and down to like 2%? Why? Because all you have is Social Security, pension, and some, RMD, retirement plan distributions. But then, your RMDs kick in here, incomes, you start jumping up in income, and then they really, right here, start jumping up. But then look at this, in 2046, here's what happens. In 2046, because of RMDs, you guys are paying $66,000. How does that feel? Just in tax. And then, John, you die. And let's take a look at the tax position you leave Jane in. It jumps from 66 to 85. So it goes up, 20 grand. And look what happens after that. 90, 100. This is not income. This is just the tax bill. 112, 122, 134. Tell me, is that the position that you want to leave Jane in? And they always say, like, holy crap, no. I mean, heck, do we even want to be in this position where you start your RMDs are like 27 up to 66? Do we even want to be here? No, we don't want to be here. So is that something that maybe we might want to work on? Would that give us, is that a problem that needs to be worked on? Yeah. And what's really cool is the system shows it to you. The other thing I'm curious about is, and I do this all the time, I wonder a couple of things. I wonder how much this all adds up to. But I also wonder, what's the probability that you've got enough money that your income's going to last? Well, we can hit this button, Test Plan. And now it's going to run a Monte Carlo analysis. Now, I don't normally get into this with most people. We will get into this with clients and we're reviewing their planning. I don't normally get into it with prospects, but this might be something that you want to talk about. It's really up to you. But I always tell people whenever we're testing this plan, just so you know, it is not testing whether or not you're going to run out of money. What it's testing is, what is the probability that you're going to have to tighten your belt? Because most people would rather tighten their belt than run out of money. In this scenario, I'll look at this. 96% of the time you're good, 4% of the time you got to tighten your belt. Based on our, as long as this is over 75%, in our opinion, you're good. In fact, I would almost argue either one, you're working longer than you need to, or two, you're underspending your assets. But no reason to really get into that right now. So let's go back to our cash flows and the tax page. And I'm here, I'm like, okay, what does all this add up to? Well, if I hit Tax Lab, it will find out and it will calculate it. So Tax Lab is this little icon right here, the little percentage thing right here. And we're getting close to the end of what we show people, by the way. So again, for prospects, I like to show the Life Hub. I like to show under this tab right here, I like to show them, here's your income structure in retirement, and here is your tax situation in retirement. So I like to show that. And sorry, it takes a little bit for this to go. So you want to run this stuff not live in front of a prospect, but have it all run before they come in, and then you won't get this nearly so often. You still may get it, but normally you don't. And again, we run it and just take screenshots. We don't actually show this in front to a client anyway, or a prospect anyway. Dun, dun, dun. Come on, please be patient. This is now, we had blue spinny circle of death earlier. Now we have the blue horizontal line of death while we're just waiting. Here it comes. All right. Now here's what's really cool. This system is going to calculate the most efficient way to do Roth conversions. So I'm going to, and if you put your cursor, if you click on it, it'll keep the box open, right? The only one that we focus on is this one right here. It looks like based on your situation, if we add up all of those taxes, it comes to about $1 million of tax that you're projected to pay, assuming tax rates don't go up. But and by the way, this system already calculates the increase that we're expected to have in 2026. But if you manage your taxes properly, you can cut that in half. So right now, you're basically projected to give the IRS double. It's like you're paying them double what you need to. It looks like you should be able to save about 500 grand. So how do we do that? How do we do that? Well, to do that, I got to move my picture again. We hit this Explore tab, just so you know how it does it. And this system will say, let's figure out the best way to do it. And if I hit this Text tab right here, this system says they would be wisest to do a bunch of Roth conversions, basically fill up their 35% bracket right now in the next couple of years. And if we show the table, what we'd be asking them to do is pay an effective tax rate of roughly 25% for the next few years. And by doing that, we cannot get them to zero, but we can get them to almost 1%. And look at this. When you are 2046, instead of giving the IRS, what was it, $66,000? Now you only have to give them $1,000. And then you die, right? You die in 2046 for poor Jane here. Instead of this jumping to 85,000 and growing, well, it jumps to 2,000 and it's pretty stable. So we can get you in a much better tax position. By the way, I'm not saying this is the smartest thing to do. If I click this down here, there's a lot of different options, right? We can do, we can do Roth conversions underneath IRMA brackets and all this kind of stuff. There's a lot of ways we can play with this, but this system will, here, view strategies. There we are. This system says, based on your situation, the math says, and what it's doing here, it's going to calculate total tax. What's the smallest total tax? And, we might say, given all of this, maybe we could look at, some of these other options, right? Maybe we say, I don't know, this option right here, right? We can just say, let's look at, I think we can just click it if I'm not mistaken. Yeah, viewing now. And now when we go back up to now if I hit X, now it says this is what that would look like from a Roth conversion process. So it just takes longer to get to the low tax bracket environment and say, hey, you're paying 25 now, but then it's going to be, pay 12 to 15 before you get to that. And you see pretty quickly, it just doesn't work as well. So I'm going to go back to where it was originally. And that's what, that's kind of what we show people. So there you go. That's kind of the sections we show. The dashboard gives us, you click on this and this is the one that talks about if you want to see, I didn't show you this, income expenses, you can kind of see this thing if you want to look at it, income goals, income analysis. If you want to see, expenses, what those are, savings. Da, 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 da. I think if I'm not mistaken, yeah, cash flows. Okay. But this is mostly what we show people. This one right here and this one. Income sources, taxes. That's what we show people. How much tax can we save? And of course, the Life Hub here is the one that people just love because it's pretty. So I think with that, I can go ahead and end this video. I know it's a little bit longer one, but I think hopefully you've gotten some benefit out of it. So this is how we set it up. Once it's set up, it just does it for you. Oh, one last thing before I forget. One last thing before I forget. There's one last thing that I don't want you to miss. Let's get my income lab pulled back up again. Burn, 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 burn. Oh no, where'd it go? Sorry, just a second here. There it is. It should be back now. The one last thing is once you have this set up, here's something really cool to do. See up here where it says plan scenarios, you click current. Here, I'm going to shrink this down so I can, there, like that. Hit current. Click this little 3 icon thing and hit copy plan. And then you're going to hit, this is what we do, retire right planning, because right's our acronym. And then what I do is I go to expenses. I only change one thing. Under expenses, I click it. And then I go to right here, change this, click it. What can I spend? Done. And then I hit save and finish. And what this is going to do is it's now calculating. So I'm just going to click down here and now it's running our little calculation thing. Look at this. Under current planning, what did we learn? If I click this button up here, nominal, monthly, gross, and variable expenses. Let's hit reset. There. Come on, come on, come on, come on. Why can't I hit my variable expense here? Nominal. Hit our gear icon here. Oh, cheese o Pete's. Dashboard. I want nominal, monthly, gross, variable expenses. Let's go back to net, right? Here, let's apply those changes. There. Let's go back. Done to done. There we go. Nominal, monthly, net, variable. Okay. So now this tells us there's R11. That's where we were. But by changing that to what can I spend, when I click right here, it's going to tell me how much I could spend if I wanted to. And so I do that. And now it's going to say nominal monthly net. You could spend 14.9. We were at 11.2. So here's what this does. It's really cool. It says, look, if you want, you can spend another $3,700 a month. That's like 3,700. What is that? 45,000 a year or something like that. If you want to spend another 40,000 a year in retirement, you could. Over the next 10 years, that's like 400,000, right? I think I could even show annual here. Yeah, look at this. You could be spending net 200 versus annual nominal annual net current 200 versus retire right planning. This number should be much higher. Yeah, something's not right here because monthly it was 14,000. So the math annually is not adding up. Yeah. Okay. Sorry. Got a little glitch in the system. So I never showed them annual anyway. So yeah. Anyway, you could spend 3,000 a month more. Over the next 10 years, it's like 350,000, 400,000 more that you could spend. So here's and that's what you could do if you were working with us. So here's my question. Is that important to you? And what's the first thing you're going to cross off your bucket list? Right? So I forgot to show you that. That's really super powerful. So we use Income Lab for this, where we can show here's how much you could spend if you wanted to. Doesn't mean you have to, but that's what you could spend. I like to show that. And we like to show the tax lab. That's powerful, how much tax you could save. And then on the cash flows, the taxes here, beautiful. But one thing you might want to point out on this income tab that I didn't say is you can kind of see in retirement, look, you want like in this year, look at the very top, 12, watch, look at this number up here, right? 12,000, like try there, 12,000 a month. How much of that's guaranteed or protected? Well, 4,500 is coming from the portfolio, right? So Social Security, rental FIA, that's protected, but 4,500 is at risk. A third of that, oh, about 40% of your income is at risk right here. And then when you die, John, look at Jane. About 60% of her income is at risk. Are we comfortable with that? Or would it make sense if we could try to protect? We like to protect at least 80 to 90% of your income. How would you feel about that? So that's another thing that we like to talk about. So income and taxes, this system is fantastic for it. All right. I think that's enough. I'm going to go ahead and stop. I hope you found this helpful, and we'll talk to you again soon.